Hello, hello. Can everybody hear me okay? Can everybody hear me okay? Okay, good, good. All right, we're going to give people just a minute to get all signed in here. Um, Emily, if you're in the room, okay, let me look at this. Okay. All right, so Emily is in the room. She's going to help me with the questions. We're going to let some more people sign on here because they're figuring out how to get out and back in. So I want to give them a minute. It's really just not fair, and I don't like Zoom for this reason because I have no idea how to use it, nor does anybody else. Emily, did you enjoy what Alex was talking about during his presentation?
Of course, always. Alex is a treasure.
Oh, he is awesome. He has helped so many of my clients, and I just enjoy working with him. I talk to him every day, even on Sundays. So he really is intertwined with what I do through Fantastic and in my personal life. I mean, he's a good friend. So, guys, as you're coming in here to the room, I hope that you enjoyed his presentation and we are going to get started. Just wanted to give people just a few more minutes. Some people have to sign out completely and sign back in, so it takes a minute. And I'm not sure why that happens that way. Some people may be in the lobby right now, and I think if you go to the bottom of your screen on the Zoom, you'll see where it says enter webinar. So if you're out in the lobby and you're wanting to come in, maybe that'll work. I'm just not sure where you're at and what's going on here. Oh, that's what you have to keep doing? Okay. So he is amazing. Alex is amazing. And Emily, I was talking about the young fellow that my other daughter met who said that he was going to be a millionaire by the time he was, certain age in his 30s. And I'm like, what are you waiting on? Do it now. And I shared Alex, and he did it at 25, maybe younger, because he's 27 now, but he has been such a success and he's doing so well. Okay, so we've got 74 in the room, and I know there's many, many more somewhere because they were in Alex's room. So I hope that they get to jump back in here. But I want to start with hello, Texas. You're in your 70s. Oh, wow, you're just getting started. Okay, we got more coming in. But the way I want to start this session is I want to share with you a, a part of a book that I am looking to write. Okay, so I'm in the process. Emily's always on me about, you've got to work on the book. And I don't take a lot of time for that because I just don't have a lot of time to put on that. But I'm going to share with you a segment of it because I want you all to feel what I was feeling back in the day and see if you can relate. Some of you people that are parents, just see if you can feel where I'm going here and why fantastic is more than just a job to me. So, okay, here we go. I'll just start reading. I have a collage of pictures containing my daughter's photos. I have three daughters from birth through high school, and it's on my office wall, so you can't see it, but it's over here. Um, I glance at it often because it reminds me why I do what I do. The culmination of absolute joy and absolute pain are presented on that wall. The joy of having those precious babies, watching them grow, feeling their love. The pain of having to leave them, sometimes weeks at a time, to work just to make ends meet. The pain of them wanting to spend time with me and me with them, but due to exhaustion of work or the marital strife, I wasn't present when they needed me. The pain of not being able to provide things they wanted and sometimes even things they needed. The pain of knowing I didn't spend the time I had with them more wisely. I could have played more. I could have read to them more. I could have watched movies more. The vacations I should have taken with them, and just the time I could have spent listening. All of that pain with a mother's guilt of not being there mentally, physically, and emotionally. Okay, I'm going to try not to get upset because this is a real pain for me. Okay. And my hope with Fantastic is that you guys who are parents, that you focus on what's important. Now I get to focus on my children. Since if you know my story, I am a certified welding inspector by trade. And when I stepped into that line of work, stepped away from the marriage that was just consuming me with turmoil, hour after hour, day after day, then I could start spending some time with my kids. But like I just said, I had to go out weeks at a time on job sites to where they had to be alone. And Emily, who's present, she was my oldest, so she would help take care of the younger ones. But I don't even think I saw my youngest one the first 3 years because I was in and out. It was just, I had to work and I had to make life better and I had to buy a home and I had to buy the cars. And so this is a lot of pain in my life. And when I read this, I hope that you feel exactly what was going on for me because that's real pain. And that's what I want to prevent you guys that are still at home with your children to get your mind off of this stupid stuff called debt for sure, rocky relationships. If you are having to fight for your relationship day in and day out, and you're trying to fight that spouse to talk to you, to love you, to be with you, to enjoy time with you, anything that has strife is not blessed. And I'm not an advocate for divorce. I'm not saying that. But I'm saying I spent 17 years trying to change a man that did not aim to change. And my life began when I found my codependency, corrected that, and got rid of him. Now, I'm sorry I sound like I'm coming across angry with that, but I had to stand up for myself. And the good Lord helped me all the way through it. And I'll be forever grateful for when I finally got some self confidence and decided, hey, I don't have you anyway because you're not my friend. So I can do this alone. That's when things started getting better. So I'll go on. I still feel that groaning of wanting to do it all over again, but better. The guilt that never goes away because you know you could have been better. That's why I do what I do today. If I can help one mom or dad out there to avoid that pain by sharing my story of bad decisions, relationships full of turmoil, and the 712s that I had to work, wasted time, then I'm going to share it. Velocity banking was a means to an end for me, an end to the financial struggle I had endured through my childhood and all of my adult life at that time. My prayer is that you too find a means to an end of your struggle through velocity banking. Okay, sorry about that. Sorry about that, but I wanted to share, where my heart is, why my heart's where it is, and sincerely let you know that I am you. And if you're in a struggle, I have been there so deep that I'm just forever grateful for where I am today. And I'm so thankful that I get to speak to you and hopefully help you out of whatever situation that you're in, especially financially. Okay? So let's get back to work. I'm going to run over a scenario here just to give you an idea of velocity banking for you guys who are completely new. You need to understand what velocity banking is, and all velocity banking is using a line of credit, a revolving line of credit, to transfer debt into so that the payments clear up and you have cash flow. So that's what we're going to talk about right here. Let's see. Total expenses 5,027. Let me put the cash flow here. 4,900 is the income. Why am I using 4,900? My average client, the income is about $7,000 to $8,000. So that's the average that I work with. But I've had people as low as nothing, all the way up to $100,000 per month. Okay. It doesn't matter how much money you make. It's about what you're doing with it. And so you can make, $2,000 a month and be broke, and you can make $100,000 a month and be broke. Okay. So with this one, we're at a $4,900 income. The living expenses, what are living expenses? That's your food, your car gas, your utilities, your subscriptions. Do you pay tithe? Do you give? Do you buy clothes? Whatever, car insurance, whatever you spend in a month outside of your debt payments, that is your living expenses. Okay. So this person has a HELOC just obtained at 8%, $25,000 limit. That's what we're going to use. That's going to be our debt tool. The credit cards here are listed and with the payments every month. She also has a personal loan with a $7,000 balance, 300 payment. Car loan, 16,000 balance with 690 as a payment. So the total expenses, correct me if I'm wrong because I'm not a mathematician, we all know this. 5,027, which means she has a $127 negative. Okay. So in the chat, tell me how many people in the room are in a negative. If you're in a negative cash flow, meaning that after everything's paid, you don't have enough money to pay, okay? Your bills, all of them. You have to like eat less. Maybe you like say, okay, we got $50 this week to eat on. I have been there. My girls have gone without Christmas before because there was just no money. Okay. So I'm with you. All right. So let's talk first. We went over the scenario. Let's talk about the line of credit. Now, most of the time, and in every situation that I've had, I made sure that my line of credit was with the same bank that I have my checking account. Why do I do that? Because you can do easy transfers back and forth. Okay, that's the reason. If your line of credit is outside of your bank, then you're going to have a 2 or 3 day delay from the time you can get the money to the LOC into your checking. You can do it, but it's just a more difficult way to use a line of credit. Now, when you get paid, they do a direct deposit, right? So the direct deposit of your income goes into your checking account. Now, when the line of credit is here, and we're going to use the example of where we're going to put some of the credit cards into the line of credit so that we can gain some cash flow. So with this, let's say there's a $2,000 balance on the line of credit, and then you get paid $1,000. So $1,000 goes into your checking account. So if you're like I am, I literally did it right before I started this session. Went to look at my bank account. I saw there was some funds sitting, money, cash, whatever you call it, sitting in my checking account. I went straight in, transferred that over into my line of credit because I do have a balance right now because I had a lot. There's interference happening. Anybody experiencing that?
It sounds good on my end.
Hmm. Okay, just wanted to interrupt that. So I went to my checking account, saw money in the checking, transferred it over to the line because I just did a major chunk into my infinite banking. I can't wait to hear that conversation tomorrow. So, because I have a balance on the line for making that premium payment to the infinite banking, I have a balance on my HELOC right now. So, I took the money over, transferred it in here. So, if this person had $1,000 come in for their paycheck, they would transfer it into this line of credit, and it accomplishes two things. One, it knocks the balance down. So this causes your interest charges to go down. Two, when you transfer funds from your checking into the line, that's going to satisfy whatever monthly payment they're asking for. So you essentially killed two birds with one stone. You made your payment, you reduced your balance. Now, what happens when you go to a restaurant and you eat? Let's say you need $50, and that would be a fast food these days. So you would transfer the $50 back into the checking and then, use your debit card, draw cash. I charge everything on a credit card throughout the month. I want to be clear with that. Why do I do that? Because the credit card has that 25-day cycle. So your credit card for 25 days, it starts on your statement date and it starts counting 25 days to your due date. Why? Why is it important that it sets the due date and they want your payment there? Because the whole 25 days you're at the high balance and they're drawing interest off of the high balance because you're leaving it there. What happens when you have, and I said this earlier, when you have the $200 payment due on the due date, but you come in and you make $50 payments up until the due date? That makes them reset. Every time they have to reset the interest cycle. So they're calculating on the average daily balance. So when you're hitting that more often, you're dropping the balance, and they're like, here we go again. They reset it. Here we go again. You hit it again. You drop the balance. So it's helping in two ways. One, the $50 adds up to the 200. So as long as you do it after the statement date and before the due date or by the due date, you're going to satisfy your payment. But two, you're helping with your interest charges. And three, this causes a boost in your credit score for some reason. I don't know why, but it will cause an increase in your credit scores. So, this is the credit card. Here we are. I was just sharing that because I charge everything in this 25-day period. And then I have everything paid off by the due date so that I pay no interest. Now, if I were to put it into my line of credit, all of my charges throughout the month, then it's going to hit the line of credit, and the line of credit doesn't have this 20 days free interest, 25 days, okay? So the line of credit, it calculates daily as far as when they on your statement date when they're calculating what your interest was, they do it by the average daily balance, but they're still every day, you're going to get an interest charge. The credit card does not do that, thank the Lord. They're high enough without that. So that's the idea of having your credit cards paid off by the due date from your line. So I take from my line of credit and I put into the checking, then make the credit card payment. It clears the checking, and I now have the credit card balance in here. That's okay because your income's going to go in and work that back down. Okay. So where's my eraser? Let me finish this off. I just wanted to show you the way that revolves. Now let's talk about the difference between the line and the loan. I have so many people come to me and they'll say, I didn't even know there was a line of credit. When I go to my bank and I tell them that I want a line of credit, they try to push a loan on me. Why? Why do they do that? Well, a big reason is the bank makes more money off of the loan, the mortgage, the car loan, the student loan, the personal loan, right? There's all kinds of loans out there. The SBA loan that a lot of you guys are wrapped up in, that they act like that 3.25 is such a great deal when they let it set for a whole year before you even started making payments, and they stockpiled that interest on that amount while you weren't making payments. And now when you make a payment, most of it goes to interest. Yeah, that SBA loan. Okay. So when you have a payment due on a loan, you put the payment, right? You make the payment on the due date, right? It goes in. Once it's in here, it's like a suction of something that, if you had a pipe and you had a suction on it, and, well, a vacuum, for example. So you're going through and you see a piece of fuzz and you suck it up and it disappears, right? It's gone. Now, fortunately for the vacuum cleaner, it goes into some kind of little thingy for us to be able to pull it back out if we wanted to. But this is like a suction. This is that payment goes in and it fizzles out and it's gone and you never see it again. They took it. Another thing that's a problem with this is if you have a $500 payment, depending upon your interest rate, you could have as much as $400 going to interest, meaning that $100 is all it's going to pay down on the principal amount you actually borrowed. Okay, so if you borrowed $5,000 and your interest was 400 out of your 500 payment, that would mean that your balance is now 4,900. Give you an example. I worked with a guy, he had a motorcycle and he was wanting to trade up to a new year. And he had been paying on the motorcycle for, I think, 4 years. And when he was excited because he's like, I paid this down enough that I can just, literally get the value out of it, and they'll pay it off and then I'll buy the new motorcycle, just that purchase amount. He said when he got to the dealership and they called his bank for the payoff, he said it was almost the same amount I borrowed 4 years ago. He said, I had no idea that every payment that I was making wasn't even going towards my bike. Most of it went towards interest. And he said, so I couldn't get the new motorcycle because I was going to have to come up with money just to finish that loan out after the trade value. So that's what I'm talking about. Some of you guys, and I worked with you, one of you guys just a day ago, had a HELOC that was interest only, which mine is too. I love that. I have no problem with that. But they thought that making that monthly payment they were sending them was paying down the HELOC. And they had been paying on that thing for 5 years, and it was still the same balance as when they took out the loan. And it did not occur to them until they saw a video that, am I just making interest only payments? And that's when they went and checked and they saw that the balance was the same. I have personal people, not going to say names, right here. They've been paying on a HELOC for almost 10 years. It's about ready to renew, and they've not worked the balance down at all. They have been making monthly payments of about $1,900 a month, and it is all interest. So please be careful with that. That's what we're talking about here today. Is I'm going to talk about the second position HELOC. I'm going to make sure I don't run out of time. I've been talking a while. Okay, so we still have 30 minutes. So let's talk about when this goes in, it goes away, you never see it again. With the revolving line of credit that I just talked about, when your $500 goes in, this is open-ended. That means that you can pull it right back out again and put it into your checking. So that is what we do with Velocity Banking, is we put our income into this line and we let it sit here, working the balance down until we need it through making another payment or paying our expenses or taking a vacation. Then we can pull back out what we need, and your income has worked for you, every dollar of it. That's what I want to see happen, is you guys are using your income to serve you, because you're killing yourself every day. And some of you guys have 2 and 3 jobs. Some of you are working bukus of overtime just to be able to eat. That is what I want to show you today, is how the line of credit can help this person come out of the negative cash flow, putting them into a positive cash flow. Okay, I want to make a quick statement here. If you don't have a line of credit to work with, as this person does, then Money Max can help you. So I don't like to leave anybody in a negative mindset of, oh, I'm never going to get out of this. So if you are in a negative cash flow, you need to get the free analysis with Money Max, just so you will know if that is going to help you until you get to a point that you can get you a line of credit and start really paying off that debt too, okay? It works. It doesn't matter if you have one, if you don't have a house or you do. It doesn't care about your credit score. That's why Money Max works, okay? Now, that being said, let's go on with this scenario. And Emily, if I have any questions pop up, please let me know because I can answer them.
Okay. A few people just want to verify that this specific workshop is going to be recorded.
It is recording. Yes.
Perfect.
Yes, it is recording. Okay, so we're talking about a $25,000 limit on a HELOC. For you guys who don't know, a HELOC, you do have to own a home. It's a home equity line of credit. Okay? All right. So, and I was thinking too, because I get this question all the time, how do you know how much your HELOC could be for if you have a good credit score? And this is how. Let's say you have a $300,000 value, your house appraised for $300,000. Let's say that your mortgage payoff is 500 or 200,000, okay? So your mortgage balance is 200,000. And okay, I just really missed a step here, so let me start back here. We'll come back to that. So the way they calculate how much the loan to value is that they're going to allow you to borrow in your HELOC, most states it's 80%. I've seen 90% in some states. It all depends on your state, but we're going to do loan to value 80%. So 300,000. I think I put in 3 million times 80% is 240,000. So this is your loan to value on a $300,000 home. Now, out of that 240,000, they have to see what the balance is on your mortgage because this mortgage is already taking up your equity. People are so scared of a HELOC, and if it wasn't for the fact that it's so sad people don't understand the HELOC, I would laugh out loud because the HELOC and the mortgage both are depending upon your equity. So people say, "Oh, I don't want to get a HELOC because then that'll take up my equity, or that'll be on my home." Well, it's like, dude, you already got a mortgage on it. Do something now that's going to help you pay off the mortgage, just like the videos teach. So that being said, you would have $40,000 available in a HELOC if your bank approves it. So does this make sense? It's your value times whatever percent the bank allows in your state, getting that loan to value amount, subtracting out the balance that you have on your mortgage. That is what is available for you to take or borrow from the bank. I hope that makes sense. Right now, the HELOC interest rate's the second position. I've seen from 6.5 to 8.5. It just depends on your bank. Okay. Position one, or the first lien HELOC, the all-in-one, same thing. Harrison is coming on next in the next session, and he is going to lay that out for you. So I'm going to talk about the second position because he will grab the first. Okay, so I'm going to get a pen that is going to write for me. Okay, so let's start with this HELOC. Remember, she's in a negative cash flow. So to bring her into a positive cash flow, I am going to start with, let's pay the $2,500 credit card into the HELOC. So 2,500 is now the balance of the HELOC. Okay. Now we paid that off. We've gained 160. She is now out of the negative. Does that make sense so far? So since this is a $25,000 limit, I'm going to throw in the $4,000 balance of credit card number 2. Now she's gained 250 more in cash flow because she no longer has either of these debts. And her cash flow now 250 plus 160. And then we have to minus out the 127 she was at. So $283 is now her new cash flow in one step. Okay. So her balance on the HELOC now is 6,500. Okay, so just like I showed you in the example where your direct deposit comes into your checking and you transfer it over into your line of credit. That's what this person's going to do. Now she's paid bi-weekly, so she's not going to get 4,900 in a chunk. Like I said earlier, I check my account every single day. If there's $50 in there, I'm transferring it over to my line of credit because I'm keeping the line of credit at a lower daily balance, okay? So when she brings her 4,900 after she makes the 2 deposits where she gets paid bi-weekly, we're just going to show it by the month so that I can save room on the board. So 6,500, subtract out her income. Now she is showing 1,600, but she has to pay her living expenses throughout the month. She has to keep making the payments that she makes. So 1,600 is the actual balance that she has on the HELOC. Now she's just going to go pay her expenses like she always does anyway, but she's using the line of credit to do it instead of leaving her paycheck in the checking account to do it. That's where we feel like that the paycheck just fell through our hands. It's like I got paid yesterday and today I don't have enough to get to next week. I've been there. That's what the checking account does for you. Okay? So using the line, you're always going to have some funds available to get you through the month. Then you just keep throwing your income in there, funding it back up. That's all we're doing here. Okay? So let's see how this works out. So she's at 1,600. She's going to pay 300 or 3,000, I'm sorry, for her living expenses. Remember, this is food, gas, anything else, tithe, whatever you do throughout the month. And then we're going to add up the payments we have left for 10, 210, 300, and 690. So she has to make $1,610. Now I know some of you are screaming. I can just hear it through this video. You're saying, yeah, but you haven't added in the payment for the HELOC. Don't deny it. I know you were sitting there saying that. When your income goes in, like I just showed in the last example, you have satisfied any monthly payment that will be due on this HELOC. So that's why you don't see a HELOC payment. I'm getting ready to apply interest because you will see that on your statement. Okay. So let's add this up. 1,610, 1,600, and 3,000. So that's 6,210. And then let's add some interest. So the bank does the average daily balance. I'm going to take it off of the high, okay? And I'm going to say this HELOC's at 8%. So the high balance is 6,500. If you're doing velocity banking right, you'll never pay on a high balance because you're better than that. So it's going to be about $44 interest. So she's at 62.54 going into month 2. Okay. Month 2, the income comes in again, 4,900. Remember, these are paid in bi-weekly. I'm just showing monthly to save the board. So 62.54, subtract out 4,900. 13.54 is now her actual balance outside of her expenses. So 13.54. Then we're going to add in the living expenses and the payments. I'm putting them together, so we're saving room. So 46.10 is the total living expenses. And then we're going to add some more interest. So we're going to take the high, which is 62.54, calculate the 8% interest divided by 12, $42, we'll say. Okay, do you all see what's happening here? By month 2, the end of month 2, with the interest already included, she has paid this down to $6,006. So this is going to keep going, but if I were her, I would come over here and grab another debt and gain some more cash flow. So she could put 3,800 in here to pay off credit card number 3, and then gaining the 210. Then in month 3, her income goes in again. This is just math. So 9806. Income out means 4906 is her new balance. We got to add in expenses. The expenses go down because she no longer has the $210 payment. So we're going to take the 4610, subtract out the $210 payment. So now her expenses are $4,400 a month total. 6. All right, and then we're going to add some interest, and we'll take it off of this high balance of 9806 times 8%. So say $66 interest. Then month 4, the income goes in again. Let's see where she's at. 93.72. 4,900. So 44.72. Can you all see this kind of? All right. That is where she's at going into month 5. She's paid off 3 credit cards. Let's see, her cash flow is now you take the 127 off. We're going to add in the new. So now she has $493 cash flow after she started with a negative 127. So this would just keep going. You keep pulling debt into the line, gaining the cash flow. And we're talking about, if we look to see what the 44.72, if she just left it there, let's just see what it's going to look like for a payoff. Oh, it's 4,900. 4,900 income, 3,000 in expenses. Uh, we'll do the 410. Uh, 300 and 690. Okay, so that means with the interest, I gotta account for that too. This would be paid off in 9.5 months. So 9.5 months, she would have paid off 4,000, 3,800, 7,800 plus 25, $10,300 in 9.5 more months. And we wouldn't let it go that far. I would go 4 or 5 months, pull another debt in. I would be working that debt down and gaining that cash flow. So I hope that makes sense. That was just a really quick way to flip a negative. Does anybody have any questions about what I said?
So, can you explain just really quickly what the difference is when we're looking at a HELOC 1 versus 2 versus 3?
Okay, so three, you don't see those much. I have seen them, but you don't see them much. That means that two different banks took the second and then the third at the other bank. Doesn't happen much, but that means you have a lot of equity available in your home if you've been allowed to do that, which is kind of counteractive because if you put it together, you could have just one HELOC and you could be revolving it. So I hope that answered that question. The first lien HELOC. Now, I wasn't using a mortgage on this example, but the first lien, let's talk about it. I showed you the second position where you have a mortgage and you have a HELOC. That's the second position. The mortgage is in first position, okay? Now, if you have a mortgage and say it's 250,000, this is your mortgage balance. And you have a value of 400,000. Okay, so your home appraises for 400, you've got a $250,000 mortgage, and you want to turn this mortgage loan into a revolving line. That is a first lien. That means the mortgage is gone, and now your 250,000 is in a first lien or position HELOC. It's a revolving line of credit now. It's no longer a loan. Okay. The 8% that this line of credit would have had last year, they're down now. But I calculate these every day on an 8%. And I don't even care if you have a 3 or 4% mortgage rate, interest rate. This line of credit, same balance at an 8% simple interest revolving line of credit, will pay it off in almost always half of the time. So it'll take a 30-year mortgage down to 15. Does that anger you? Does that anger you that you're finding out that the 30-year mortgage they put you in is 20 years plus of interest only? That's why it takes 30 years to pay your home off? Every home can be paid off in 5 to 10 years, all depending upon your income. That, when I learned that, it angered me because I'm like, nobody knows this. And when I talk to people around here about it, they'll say, yeah, well, that's just the way it is. No, it doesn't have to be. You can change. All right, Emily, anything else? I've got
Well,
8 minutes.
Yeah, we have a few more minutes here. I'm watching the chat, waiting to see. It's been a little quiet lately. Can somebody wave at me and let me know that the chat's still working on my end?
Well, I hope that maybe I was making it clear. How did you calculate the interest? That's a great question. Let me just show you right quick. So when we're talking about how is interest calculated, which interest to me doesn't matter, okay? It doesn't matter to me because I'm going to be working it down so fast with velocity banking that they're not going to get much from me. These credit cards here I showed you, they're all over 28%. This was an 8% HELOC I showed you. Did you see the interest charge on having these balances in there? Wasn't the high $66 a month? The high? How much are you paying in interest on these cards? Well, let's do the calculation with the interest that she just asked about. A $4,000 balance, average daily balance on a credit card, times this case 28%, and just do it with me. Get your calculator because I can't do it. I can't do it in my head. So that's $1,120 per year. You have to know. People will write me all the time in the comments and they'll say, that totals $1,100 and you said it was only $80. Well, that's because this is by the year. Okay, then you divide it. If you want to know the daily rate, you would do 365 because there's 365 days in a year, or you would do 12 months. So when you divide 1120 by 12 months, that's 90. What am I putting forward for? That's $93.33. So that would be your interest on a $4,000 balance at 28%. 93. I just had these paid off at 66 for all three. This is just one card. Do you understand that the interest here? I love credit cards. I don't want you to cut them up. Just saying that. I love to use them because they gain me cash rewards and then I pay them off on the due date or really before. So this line of credit here at 8%, the overall interest for all three cards was only $66. So you're probably paying close to $200 at least in interest just on these three. Look at this personal loan. I know that's eating them up. Okay, 5 minutes. Then we're going into Harrison. I love Harrison. I have a credit card with 10% interest rate, a line of credit with 12% interest rate. Could you explain which one I should use? I personally would use the line of credit because all of your income can go into a line of credit. Only chargeable expenses can go onto a credit card. So you can charge your food, your gas, and you can put your income in to cover your monthly expenses. But the line of credit will allow you to put all of your income into it first, knocking that balance down. And then whatever total expenses you can charge throughout the month, you can take from the line of credit and put into the credit card. So you're killing two birds with one stone. I hope that makes sense. Okay, we're gradually getting all of our automatic payments and payrolls transferred over to checking. With the institution, we have a HELOC. How should we then determine which of our debts we begin knocking off? Unfortunately, the HELOC had to go for long overdue house repairs. Oh, okay. It's going to have to be considered a debt. If you have cash flow, then you're going to have to work that HELOC down first by transferring the income in, pulling your expenses out, working that debt down. Okay. Yes, so Harrison is getting ready to jump on with us in the next session. He will explain that. I think he does every state in the US. I have one lender, another lender that only does, well, it does every state except Texas, Maryland, Hawaii, Alaska, and New York. But Harrison's group works with every state. So you can talk to him about the first lien HELOC or the all-in-one. Same thing when you hear that, okay? Maybe you need to check with another bank, Amanda, because there's no reason if you have 135,000 in equity that they wouldn't give you more than 35,000 unless your DTI won't allow it. And if they had any sense, the bank would transfer some of your debt into the HELOC to bring your DTI down. Okay? Some banks do that. I don't know why. The HELOC takes about 30 to 45 days to get into. Some HELOCs I know of are a couple of weeks. It depends on the bank. If you are self-employed and you cannot verify your income, and that's the problem with getting a HELOC, try homebridge.com. I know that I went in just to do that approval process. They take your deposits, what you're having going into your checking. They didn't do an appraisal. They just did that appraisal where they look online to see what your equity is available in there. So it seemed like a good bank. I read through all of their contract. I didn't see anything, but it is going to be in a bank outside of your checking account. So you will have to transfer those funds back and forth, which is a 2 or 3 day delay. It is a huge difference between Canada and the US. Canadians are really, really not in a good position with the way they set up their mortgages to refi every 5 years. That is painful for me to even say that they would do something like that. But yes, it's very different. Very different. Okay, guys, we got 1 minute. Harrison's about to start. You did get a HELOC from Homebridge. Thank you for the recommendation. Yay! I know it's even hard for me being self-employed to get a HELOC. So I know that there's just a difference there. Um, let's see, with all those credit cards with interest, should you apply for a balance transfer yes, the 0% balance transfer into the 0%. That's an excellent idea too. Uh, Harrison George is CMG. CMG. Oh, Homebridge. Yes, that is homebridge.com. I'm no association, so please don't say, oh, she's sending them over there because she makes money off of them. That's not true. I had a client tell me they had gotten their second position HELOC from them. I went in to check it out. I did the approval process. I read the contract. I didn't see anything that looked fishy. I canceled mine because I didn't want another HELOC. I already have one right now. But I did do that just for you so that I could verify what their approval process is and what their terms were. That was so important. It looked good. I don't vouch for anything. I'm not your financial advisor. I'm just going off of experience. Looked like a good place to me. Okay? All right, I'm going to go over to join Harrison. I hope you will come with us. He's going to talk about the all-in-one. Maybe, maybe not.